Hello, greetings, and welcome to Dividend Blasters. This is our 35th video. Topic today, dividend increase announced by Lowe's. Ticker symbol LOW. Yes, Lowe's, the home improvement retailer, is announcing a dividend increase of nearly 5% for the next quarter. Let's get into that. Quick disclaimer, I'm not your financial advisor. Purpose of this video is for financial information and education. It is not financial advice. So please do your own research, do your own due diligence, consult a financial advisor before making major financial or investment decisions. Okay, as I just said, Thursday, May 25th, Lowe's declared a $1.10 share quarterly dividend. This is a 4.8% increase from the prior dividend of $1.05. Forward yield is 2.19%. So in annual terms, as a shareholder, you would get about $4.40 per dividend each year. The ex-dividend date is July 25th. So to take advantage of this increase, you would have to get your buy order in before then. It will be payable on August 9th. Full disclosure, I am a shareholder in Lowe's and have been for a while and couldn't be happier. What I'm going to do is I'm going to go through some basic metrics of Lowe's, give you some information on how I see it as an investment, how I see it stacking up against its market sector peers, and I'm going to focus on one of its key competitors. All right, let's press on. A little bit of background first. Lowe's operates as a home improvement retailer throughout the entire United States. They offer a line of products for construction, maintenance, repair, remodeling, and decorating. They were founded in 1921, and they are based out of Mooresville, North Carolina. Some summary metrics. They closed yesterday, Friday, May 26, at 206.52. I want to draw your attention to the panel to the right. Their earnings per share is $13.36, and it's more than sufficient to cover that dividend rate of $4.40. Also want to draw your attention to their PE ratio, or their price earnings ratio. It's the ratio of the current stock price over earnings per share. They are operating at a PE ratio of 15.45. Now, by itself, that doesn't mean anything. Okay, you need to look at it in context. We're going to look at it across two metrics. We're going to look at it, how it compares to the PE ratio to the S&P 500, as well as the Dow Jones Industrial Average. So if you look to the left, bottom panel, you'll see the S&P 500 index is more. It's 18.37. So right there, this tells you that Lowe's has a more favorable PE ratio than the basket of stocks in the S&P 500 combined at the aggregate level. We can also look at the Dow Jones Industrial Average, 22.05. Well, it's even better than that. So to me, and you know, when you look at metrics, you can't just look at one or two. You got to do some digging. But as it looks now, Lowe's looks like a very reasonable buy. Their market cap is about $119 billion, so it's a decent-sized company. All right, press on. So how do analysts rate Lowe's? Well, Wall Street is bullish. They basically rate it as a buy. And you can see that there are 35 analysts displayed in the top panel. 16 of those 35 rated as a strong buy. 4 is a buy. 14 are neutral or as a hold. 1 has rated it as a sell. None of them are rating it as strong sell. Now, the second panel are analysts that are contributors to Seeking Alpha. And a lot of the information that I use, I get from Seeking Alpha. I am a subscriber to them, and they're a wonderful resource. So in Seeking Alpha, 11 contributors in the last 30 days have rated it as a buy, not as bullish as Wall Street, but still a buy. They are in the green. You can see on a 5-point scale, it's 3.7. 1 is a strong buy, 7 are buy, 3 are hold, and none of them are sell or a strong sell. The quant rating is a little different. It's based solely on metrics, and it's basically comes out to a hold, or 3.24. You can see that profitability, it gets very high ratings. It's a very profitable company, and you'll see that their cash flow from operations is outstanding. Good momentum. Where they are down a little is in growth and revisions and valuation. And we're going to get into that in a little bit. I tend to look a little bit more closely. Well, I look at all of them, but I like to see what Wall Street says, because that kind of measures the pulse of where the psychology is around these investments and if people are buying. And you're not going to see this on any of these slides, but a lot of the ownership in Lowe's and its major competitors, the big companies, comes from institutional investors. It tends to be 70 to 75%. So anyway, wanted to share that with you. Next slide. This here basically is a summary of some of the dividend metrics. Now the dividend yield, the forward yield, it's 2.09%. It's not a bad yield. It's not anything to write home about. It's a very conservative dividend yield. And as I mentioned, that comes to about $4.40 annually. What is interesting is that the payout ratio is 30%. So basically the payout ratio is the ratio between the dividend payout and the earnings. This is a safe investment. You typically don't like to go above 60% on payout ratio. There are instances where you may breach that. But to me, this basically is a good metric. This is a safety metric. That dividend will not be going away. The 5-year growth rate. So the dividend compounded annual growth rate for the last 5 years is almost 21%. Now, this is a spectacular metric. Basically, what this says is that on average, Lowe's has increased its dividend yield by an average of 20.69% for each of the last 5 years. Some years more, some years less. That's phenomenal. You know, as dividend investors, we typically like to look at the yield and the growth rate combined and see an aggregate of 10%, because we want that continually growing dividend. This kills it. This is above 10%. This is more than 22.78%. So I say, yes, 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 bring me more growing dividends. And you know what? Let's put a cherry on top of that sundae. The dividend growth streak is 59 years. That's incredible. This is hard to do. A lot of companies do not do this. They can't do this. Lowe's has continually increased their dividend for 59 consecutive years. They are a dividend king. Next one. Okay, here's a little bit deeper dive in the dividend growth rate. I typically like to look at that 5-year cagr. It's 20.69%. If you look at how they compare to their sector median with some of their peers, more than double. More than double. Now, that's the median. So some are going to be a little bit more than 10, some are going to be less, but I can tell you none of them are more than 20.69%. You're not going to see much different in the 3-year cagr or the 10-year cagr. Lowe's comes out number one. Next one. All right. A peer comparison. So what Seeking Alpha does that I like is they pull together the peers of the investment you're looking at. And there's 5 of them here that they pulled in. Floor and Decor Home Holdings, FND, Kingfisher, KGFHY, that's the ticker symbol I'm mentioning, Betterware de Mexico, BWMX, Tile Shop Holdings, TTSH, and Grow Generation Core, GRWG. What's this one I got on the end? Well, they didn't have that in there. I guess they don't look at them as a peer, which makes me scratch my head. So I added them. I pulled them in. Home Depot. Because honestly, I can't talk about Lowe's without talking about Home Depot. This will give you some context. So first and foremost, look at the market cap. Now, you know what? I'm going to show all of the sector competitors, but my focus for the remainder of the slides is going to be on Home Depot because I look at them as really their key competitor. So market cap for Lowe's, $119 billion. Home Depot is more than double. My God, it's approaching triple, $288 billion. Home Depot is a monster company. They're huge. Number of employees, Lowe's is not a small company. They have 300,000 employees. Home Depot, 471,000. They are massive. So keep that in mind as we go through the metrics, that they have scale advantage over Lowe's. Now, this next slide speaks to total return. What is that? That's the combination of price appreciation and dividends. What you can see here is Lowe's, and I've circled it, but you can also see in the graphic, is outpacing Home Depot significantly. The total return, and the time frame we're looking at is max. So as far back as Seeking Alpha would take us, which is back to the 1990s, Lowe's is 12,567%. Home Depot's, you can see it's truncated. It's a little under 5,000. It looks like it's 4,570%. So it is more than double, perhaps 3 times. Keep that in mind. This basically just speaks to price, and the last closing price that I want to draw your attention to is Lowe's closed yesterday at $206.52. Home Depot is a more expensive stock. It is $292.83. Okay, total return and dividends. So the graphic I showed you was for the max time horizon. What this first panel shows you in the upper left is a graduated time horizon ranging from 1 month to 10 years. I'm not going to read them all. You can see them. But through each level, Lowe's outperforms Home Depot on the total return front. 10 years, 476% for Lowe's, 364 for Home Depot. Dividends. Well, we mentioned the dividend yield is 2.09% for Lowe's. That's a modest yield. Nothing to write home about, but it is a yield. I would draw your attention to the folks in the middle. These are much smaller peers. Kingfisher has a bigger dividend, but they are not able to sustain it. And the growth rate is not even worth mentioning. And I would say that the same about Betterware Mexico. There is no consecutive years of growth. So we're going to go right to Home Depot. As I said, they got a better dividend yield, a little bit better, not quite a percentage point, almost 3%. And then let's look at the payout ratio. As I mentioned, Lowe's is 30%. Home Depot's is almost 49%. It's significantly higher. It's still safe. We're not breaching the 60%. It's not bad. Let's look at the cagr. I already mentioned Lowe's has a 20.69% cagr. Home Depot's is less. It is 16%. That is a good cagr, a 5-year cagr, but it's not as good as Lowe's. And again, the cherry on top, Lowe's has a consecutive growth streak of 59 years of increasing the dividend. Home Depot, not even close. It's good. 13 years is really good, but it's not 59. They're not a dividend aristocrat. They're not a dividend king. They may become one, but it will take years. Next one. Okay, valuation. Well, what I'm really going to focus on this slide, and there's a lot of information, is the price-earnings ratio gap forward. And Lowe's has a better PE ratio. It's less. So price relative to earnings is under 15. And we mentioned that in the beginning. Home Depot's is more. It's 19. So Home Depot's is a little bit more than the S&P 500, less than the Dow Jones. Lowe's is better on both. All right, let's go to the next one. Growth in earnings, revenue growth. Well, this is interesting. Home Depot actually has better 5-year revenue growth compounded than Lowe's. Lowe's is 6.73%. Home Depot is 8.84%. Now remember, Home Depot is a bigger company. Their market cap is almost 3 times the size. They've got more than double the number of employees. They're bigger. They have scale. Net income, it's closer. Lowe's is about 3-year net income CAGR, 11.65%. Home Depot's is a little over 15%. All right, let's move on. Profitability. Well, okay, I'm not completely surprised by this because of Home Depot's size. Their net income margin's a little bit bigger. It's 10.75%, while Lowe's is 6.65%. What is interesting is cash from operations. Well, they're bigger there too, 16.4 billion versus 7.72 billion. But it's interesting is that the revenue per employee for Lowe's is much more than Home Depot's. It's almost 400,000 per employee. Home Depot's is 334. Remember, Lowe's has fewer employees, so there's when doing the metric, that number should be bigger. But when you look at net income per employee, it looks like Home Depot's holds up a little better. That leads me to believe that Lowe's probably has more operating expenses. They may have more depreciation, amortization. They may have more expenses around debt servicing. I don't know. We need to look into that. But that is interesting to note. All right, let's move on. Now, don't forget the price appreciation and the total return for Lowe's is vastly superior. So when you're taking all these metrics into account, you got to keep them all together, and you got to look at them holistically. Price performance, and I was just speaking to this when I speak to total return, but this is one component of total return. Lowe's is outpacing Home Depot at every level, from the 1 month measure to the 10-year measure. And I draw your attention to 10 years, it's 384% price appreciation for Lowe's. Home Depot, 270%. I got to tell you, folks, that every percent matters, especially when you're looking over a time horizon of 10 or 20 years. You are looking to grow as a dividend investor your holdings. You grow your holdings so you can grow your dividends. And if your dividends grow, your holdings will continue to grow as you continuously drip back into your holdings. So keep that in mind. Next slide. Okay, risk. Well, I'm looking specifically at the betas, and here, the 24-month and the 60-month. And the beta basically measures price volatility relative to the larger market. And specifically, we're talking about the S&P 500. 60-month beta, over the last 60 months, Lowe's was 7% more volatile than the S&P 500, while Home Depot was 7% volatile. Over the last 24 months, the risk level has come down, or the volatility has come down. They are approximating the same level of risk as the S&P 500, 1.0. Home Depot, a little bit less, 6%. Now, with a little bit more volatility, you're going to see up and down. But as I showed you in the price appreciation slide, Lowe's is outperforming. So there's a risk-return trade-off here. Sometimes you will trade off a little bit more risk to get a little bit more return. Something to keep in mind. Next one. This slide speaks to income statement measures. This should give you a little bit of context on the revenue front, that Lowe's is about $60 billion less in revenue annually than Home Depot. They're at about $96 billion. Home Depot is $156 billion. Lowe's has a greater revenue per share of about $3. It's not bad. It's pretty good, actually. Operating income is about half, about $12.21 billion versus $23.66 billion. So, I'm not going to go through each one of these, but really the point here is to get to scale and size. Home Depot is a bigger company, but as an investment, I'm of the mindset that Lowe's is going to give you better appreciation. And with dividends, you're going to get a better total return. Next slide. Well, here's some balance sheet measures. This to me is fascinating. Lowe's, a smaller company, has more cash and better cash per share measured than Home Depot. You see it right there. It's almost 3 times the size. So $3.37 billion versus $1.26 billion. Total cash per share, $4.98 versus $1.25. Lowe's has better cash flow than Home Depot. Now, they also have a lot of debt. They both do. Home Depot is a bigger company. Their debt is more than $49 billion. Lowe's is less, but not much less, about $40 billion. Something you need to keep in mind. The long-term debt is probably the lion's share of that, and I'm looking at $35.86 billion for Lowe's and Home Depot $37.86 billion. That's a lot of debt. So anyway, something to keep in mind. I don't like to see that long-term debt total capital ratio to be that high, but it is what it is. So they do have good cash though, so keep that in mind. Keep it all in mind. Remember, the objective here is not to specifically sell you on Lowe's. It's to provide education around some of the metrics. But I am advocating for Lowe's, as you can tell. So, levered free cash flow. These are cash flow metrics. So this is cash flow that is unencumbered by debt. Lowe's has a $5.12 billion in levered free cash. Home Depot's is $9.75 billion. You can see that the capital expenditures are in the billions for both. Lowe's is about half of that, $1.87 billion. Home Depot, $3.3 billion. All right. So what are the key takeaways? Well, I'm going to wrap this up quickly and put a bow on it. Lowe's PE ratio is better than the S&P 500s and the Dow Jones Industrial Average. Wall Street ratings are bullish. Key metrics, the yield, 2.09%, kind of modest. The 5-year cagr, 20.69%. That's amazingly spectacular. The payout ratio is, actually, it's 30.69%. That is a typo. The streak, 59 years. Lowe's is a dividend king. Home Depot has only been increasing their streak for 13 years, and the payout ratio is 40%, and their CAGR is 16%. So Lowe's wins on dividend metrics. Their key competitor is Home Depot. The Home Depot's market cap is more than double Lowe's. The risk beta for Lowe's is approximating the S&P 500. Total return and price return for Lowe's are better than that of Home Depot. Home Depot has better net income margin. Remember, they're bigger. Lowe's, however, a smaller company, has better cash flow from operations. They both have significant debt. So those are the key takeaways. I will tell you that I have been an investor in Lowe's for a number of years, and I couldn't be happier. And I do like to get that quarterly dividend, and they just announced the 4.8% increase. So I am excited to be getting more dividend and dripping more into my holdings. So that's it, folks. I hope you found this to be educational. I would ask you to kindly give us a like and subscribe to our channel, and feel free to share with a friend or a family member. Until our next video, have a wonderful day. God bless.